Hi, welcome to FreightWaves Now. We've got some breaking news for you today, things that are happening right now. Yesterday we broke the story on the NEMF, the New England Motor Freight Company. They've been around for a long time, and unexpectedly they're declaring bankruptcy. They're the 19th largest LTL provider. They're out of New Jersey, and we caught wind of this story, covered it. Check it out on FreightWaves Now. For the initial coverage of it and what people are saying, but we decided that kind of making this a special FreightWaves Now edition where we're just like focusing on this story and the disruption of it. So we're bringing in none other than Zach Strickland, the Sultan of Sonar, and boy is he an LTL expert as well. He's got a decade of experience in it, I dare say. And so without further ado, let's begin the conversation and what in the world is happening right now.
So
welcome
Chad,
aboard.
Thank you. So Chad, I pulled out the New England Motor Freight location map just to have a nice map to look at, so we have a good visual here.
This is awesome.
So they've got 39 terminals spread throughout the Northeast.
These are the NEMF facilities.
Yep. And
all over this dense, expensive area.
Yeah, dense, expensive is the key word,
yeah.
Chad. This is an expensive area to operate in. Now, New England Motor Freight is a unionized carrier. What that means is that they're going to have to pay some pensions and all sorts of other things. It generally adds a little bit more cost to the operation.
Actually, time out real quick.
Okay.
By declaring bankruptcy, do they still have to pay those pensions?
Yes, I believe they do still have some of that, but I don't think that it's going to be the full amount. They'll have to. That'll be part of the whole negotiation process about who gets paid first and whatnot.
Another quick question then, is it because of these? Well, how many LTL providers have unionized workers, drivers? Do you know roughly? Is it unusual or is it?
It's not unusual, especially in these older companies, to have the unionized workers. Like UPS, we just heard about UPS this fall.
Teamsters.
They had a strike threatened or whatnot. UPS said, you know what, we'll go ahead and just shut down. And it lasted for about a week before they came to an agreement, and they came back on, literally like the first week of November.
Yes.
So there was no major disruption there, but that one could have been huge because UPS is the number 4 LTL carrier in the country. Now, New England Motor Freight is number 19.
Yes.
And it's about 400.
Pretty big. 400 million annual operating revenue.
Yeah. And I got the list here just to kind of give perspective. You got FedEx, XPO, Old Dominion, YRC, UPS, Estes, some of the more, well-known. And then you get all the way down here to these are kind of the regional LTL carriers, or the niche ones, if you will. They don't necessarily cover the entire country. Specifically, A. Dewey Pile, New Penn, they kind of stay in the New England market, or that northeast corridor. Redaway has its own little section. AAA Cooper.
This is an excellent chart. Thanks for showing us.
Yeah, no.
We noticed that in 2016 they went up a little bit between 2016, which was a down year, and a little bit up in 2017. But regardless of whether or not they were having trouble, the plain fact of the matter is, how is the market going? This is a huge question we're trying to answer today. How is this market going to handle and absorb $400 million worth of annual operating revenue in LTL, right?
Now the first thing you have to understand, LTL revenue is a little bit more inflated than truckload revenue because there's a lot more moving parts. The cost of operation is significantly higher. There's almost like a factor of...
So you're saying there's not quite as much actual stuff, there's just so many expenses.
Yeah, there's tons of expenses. I mean, they have you have to maintain a lot more tractors and trailers, especially if you have your own equipment.
Low margin business for anyone.
Low margin business. It costs more to do LTL. They can charge more for the service, but the overhead costs of operating a network is tremendous because if you remember the map,
and we've got some
so they had 1,385 drivers for that $400 million. Now, if you do some quick math, the cost of operating in the New England market, if I recall correctly, for a Class A driver is anywhere from $25 to $35 an hour. They're paid.
Wow.
They're paid by the hour most of the time in LTL because a lot of those drivers are day drivers. They'll go home at night.
Right.
They run their standard routes and then they come back and they're done. But they get paid by the hour, and it's very expensive to operate in the New England market. just because the cost of living is so high.
If you have that many drivers, how many employees do you have? Would you estimate in the 4,000 range?
You know, there's kind of a general rule of about a 3-to-1 ratio that we've heard, and that can be true. I don't know if they had that many employees. That would mean that they had roughly 4,000 employees, which would be tremendous. I'm not so sure that they had that many employees, but their overhead costs are probably roughly about 35 to 40% of the total revenue that they had there.
Wow.
And these drivers are probably anywhere, by my estimates, they're anywhere from 30 to another 30 to 40% of the total revenue.
Yes, so a huge fixed cost burden for these LTLs.
Huge cost burden here, especially when you have 1,400 trailers to maintain.
And now sell.
Yeah, so they had, I think I saw the estimates at 100 to 400 million or 100 to 500 million dollars, huge range of potential assets there. I don't know. Which would, of course, pay down their debt, which was, I believe, $50 to $100 million.
One of the things I heard in Mark Solomon, his coverage of the story was when he interviewed an analyst who's close to the story. And apparently besides the unionized aspect, they also got into some, and I don't know how much you can add to this, Zach, but they got into some troublesome contracts with some shippers who had kind of forced them into very expensive propositions, contracts, so that they were actually losing money or just making so little that they couldn't continue to operate that way. They couldn't get out of them. And now, in a sense, what's going to backfire on those shippers is that they're going to be forced to, since they wouldn't be flexible with NEMF, now they're going to face higher rates anyway because of the burden that they put on NEMF, which is kind of forcing them into bankruptcy. I don't know, is that clear?
Yeah, no, that's exactly right. So one of the biggest problems in LTL is they need freight to move their networks, to operate. They can't have empty miles. That's extremely expensive. But they also have to make service. So if you remember on the map, they had 39 terminals in the Northeast.
Right.
So
yes.
A lot of those are going to be hub and spoke type moves. What that means is they're going to cut a truck from Philadelphia, move it up to New York, then maybe hop on over to Springfield, Massachusetts, to then deliver within a 50 to 100 mile radius around that terminal.
And a lot of it's relationship based, right?
Very relationship based.
And this is one of the big points that I think of what we're trying to point out is if this were just a carrier going from point A to B, that might be different. You might be able to absorb that freight without an undue amount of disruption. But when it's a lot of hub and spoke and it's a lot of here and there and it's a lot of who knows who, really different story.
Yeah, right? No. Truckload carriers need consistency, but they don't need consistency as much as an LTL carrier does, because if they can't cut that truck in Philadelphia with more than half of load going to New York, they lose that much money on that truck. They lose half the money.
Yeah.
Depending on how it's priced, but that's why that LTL carrier has to price it a lot higher. Now, I think I read somewhere that they had Amazon in there.
Amazon was one of the burdensome contracts.
And always the big kind of factor in LTL is do I need to fill up the truck or do I need the business? So shippers will kind of work that angle and say, hey, we'll give you a ton of volume, but you're going to have to give us a deal because we're saving you money, because you're going to be able to cut your trucks faster, move over the road, and you'll have so much volume, it'll be fine. The problem with that logic is you cannot price every LTL shipment to fill up a truck. Eventually, somebody has to pay for that truck to move, and you have to make money. And if they got into a situation where they were just making volume plays all day, because you can get desperate sitting in that environment. I was pricing LTL for the majority of my career, so I always had to say, wait guys, there's a huge shipper, huge account, but you cannot price everything to fill up the truck. Otherwise, you're going to eventually lose money on everything you do.
It's sort of the equivalent of deadheading, as we were just saying then, right? It's sort of like...
Yeah, no, it's to LTL, just having empty space on a trailer is deadheading effectively, because they're moving their trucks in the network.
You want to cube it out, right?
You got to cube it out. You got to fill it up or wait it out, and you want to do that with as much money on it as possible. So, just to kind of give some illustration, this Boston,
using some of our sonar data now, across comparison, the very expensive aspect that we're looking at here of this area.
So I pulled up a few of the bigger markets in the country, Los Angeles, Dallas, Chicago, Atlanta, and Boston, and compared them in terms of warehouse rent, because real estate
per
pricing
square foot, yes,
is kind of a proxy for cost of living expense. But it's also like a good factor of like these things kind of get pushed through logistics. I mean, the fact that they had 39 terminals in these markets, they were paying space rent for these to operate in these areas. And they're pretty good, measures of how expensive they are relatively to the country. You can see Boston is this white line right here, $6.91 a square foot. That's the absolute value isn't that important here, but Los Angeles is the only one that's higher, which shouldn't come as a shock to many people.
Right.
I mean, Los Angeles is the most expensive place.
The hub. I mean, yeah.
But the New England market is very expensive. You've got Atlanta, Chicago, and Dallas down here, and there's a huge gap.
Interesting that Atlanta is as low as it is, I suppose, not so much from a real estate perspective, but just because it is such a logistics hub of operations.
Well, there's more space in Atlanta.
Yeah,
I mean, if you think about it, it's a huge geographic space. Boston has been there for centuries. Atlanta has really only been there for like 150 years or so. So they have a lot more space to deal with. Therefore, costs are down.
Thanks to Sherman and burning it all down. Yeah.
And if we go to the next one, so this is going to be the average household income. Just to add another kind of point of reference. So you can see here, I've got the same
Boston
markets pulled up here. And just said, Boston is actually, this is where a lot of income. Like, I was kind of shocked by it that LA was even
lower
underneath it.
Yeah.
So the average household income in each of these markets, Boston is leading the charge here, but the reason these two are so high all the time is because it costs so much to live. So employers have to pay them a lot more money to be in these markets.
Okay. Yeah. So the expensive labor costs is definitely at play here in this situation.
Yeah. Labor costs, huge factor, but also just everything that they do. Like their back office workers, they all have to be paid to make up for some of this cost of living expense.
Now I'm curious, like I think that you pointed out like a whole bunch of other carriers that are regional and in the area. Now one thesis you're kind of working on right now is that Old Dominion and one other company is going to maybe be able to just hop on that and absorb that as much as possible.
So if you go back to the list, if you will, and we'll kind of work down some of this stuff. So a lot of these big guys up here.
Here's New England Motor Freight.
Yeah, there's New England Motor Freight. But these guys
Look
right
how
here.
Look how big OD.
These top 6 or so represent like 30 to 35% of the entire LTL market. This is period. This is not like truckload where you have you have Knight Swift that represents 1 to 2% of the entire truckload market.
And that's a great point, but are there regional hubs that are in the same area?
That's the thing. Not all of these operate in the New England market. Okay. That's the difference between LTL and truckload. A lot of these guys are a lot more regional, a lot more niche focused. Southeastern Freight Lines, for instance, operates in the Southeast. They do not. They have partner carrier relationships outside of that, but primarily, all their assets are in the Southeast. They focus there.
Old Dominion, however, is up there, right?
All over the country.
All over.
All over the country, but it is very much there. And the reason that I point out Old Dominion is they just came off that 78 OR.
And look at that growth.
They're taking,
between those years 16 to 17.
My point of contention.
Very few higher.
I bet Old Dominion is part of the reason that New England had to shut down, because they were grabbing that market share from the market, because their service standards are, anybody that's been in the industry kind of uses Old Dominion as this benchmark.
Yes, we did cover their earnings. Super efficient, super friendly.
But most of these carriers, like a lot of these national ones, like YRC, Old Dominion, XPO, FedEx Freight, they all have terminals and presences up there. But even if you look at some of their maps, and now we can go to the kind of the map. I pulled out New Penn and Old Dominion just to kind of give a quick couple of examples. Old Dominion's top of the class in the country in terms of LTL. They have less terminal presence here than New England Motor Freight did. New Penn, again, kind of operates under that YRC banner a little bit, but they also have less presence here in terms of terminal in the New England market. And a lot of that has to do with the fact that it is so expensive to operate up there.
Well, I have a question for you now. Now, some have been saying, some analysts are suggesting that, well, this could also be an intermodal play, and that, watch these rail lines. Boy, they're embedded in that area. The rail community is not going to be turning away from this opportunity. What do you think about that?
No, the rail and LTL do not really intermingle. I mean, what the rail would get into mostly is truckload. They have full containers. They don't have less than container load stuff like with,
that makes sense.
A lot of them are like, you have to have a consolidation facility for that to happen. And you do have carriers that will consolidate and put it on the rail. LTL companies do it all the time for long line haul moves.
Yeah.
But rail does not operate intra-regionally very effectively.
Okay.
If you think about the rail lines, most of those guys don't really care about moving something from Boston to down here to Jersey City. I mean, that's an inefficient move because it takes a while. You've got to it's like hopping on a plane going to, down the street, because the efficiency gains on the rail are really in the length of haul.
Well, I take your word for it. Way to blow up that theory. It wasn't mine. I'm just, calling it like I'm hearing it. But boy, interesting story. We are covering it for you each and every day on FreightWaves Now. And, we just thought that we'd make a little bit of a special edition for this disruptive, bankruptcy, and what's going to happen. We'll be charting it for you and looking at any angle of possible. Where are we seeing disruptions on our sonar data, using our market experts and industry analysts to interpret what may be happening over the next complicated few days and weeks, and hopefully not months, but we'll see. So stay tuned, and we'll keep bringing it to you. We'll be bringing to you the more we have answers on the story and how that may be being absorbed. We will be bringing it to you as soon as it breaks. So stay tuned. Thanks for tuning in to FreightWaves Now, where you can find us on FreightWaves.com, and you can find us on Twitter each and every business day. It's my favorite time of the day. And thanks for tuning in. And don't worry, be happy.